Welcome in. Today, we are turning a complicated but critically practical compliance topic into one clear story: restaurant tipping rules for 2026. If you operate a restaurant, tips are no longer just a guest service issue. They directly affect wage law, payroll tax, accounting accuracy, staff trust, customer transparency, and audit readiness. The central idea is simple but powerful. A voluntary tip is not the same thing as a mandatory service charge. A tip credit is not the same thing as a tip pool, and a written tip pool is not the same thing as an informal tip out at the end of a shift. Federal law gives the starting point, but state and city rules can be stricter, and they supersede that floor. So as we move through this story, we'll follow one essential question: how can a restaurant correctly separate each type of money, pay employees lawfully, and prove it when regulators come knocking? Here is the hook. The risk almost always begins with one completely ordinary restaurant receipt. A customer adds a voluntary tip. The restaurant also charges an automatic gratuity for a large party. The server is paid a tipped minimum cash wage. The team shares money through a tip pool. At closeout, the server tips out bussers and the bar. To a guest, it all looks like tip money. But under wage law, tax rules, and accounting controls, those are 5 completely different compliance paths. Why does that matter right now? Because if a restaurant uses the wrong label, the mistake ripples everywhere. Payroll withholding, FICA calculations, minimum wage compliance, Form 8027 reporting, employee morale, and Department of Labor or state audits. Imagine waking up to a wage claim lawsuit because you misclassified a service charge as a tip. Picture an IRS audit revealing thousands in unpaid payroll taxes because a tip pool accidentally included a manager for a single shift. In 2026, enforcement is ramping up across the board. So before we talk systems and records, we have to answer the most important question first. What exactly is each dollar? Now the gap. Most restaurants are operating with a fundamental misunderstanding, and the danger is they don't know it. Many restaurants still run tips through old informal habits. Maybe the policy lives only in a manager's memory. Maybe the POS uses vague catch-all buttons. Maybe service charges are treated like tips because that feels easier. Maybe a shift lead joins a tip pool without anyone asking whether that person actually has supervisory authority. Those informal practices break down hard in 2026 because the rules are layered and unforgiving. Federal law is only the floor. Some states require higher cash wages for tipped workers. Some states limit or outright ban tip credits. Some cities add their own wage standards on top of that. And the December 2024 Federal Restoration Rule moved away from rigid time-tracking limits on tip credits, but it absolutely did not remove the employer's duty to pay lawful wages, give proper written notice, and protect every employee's tips. The gap is not just a knowledge problem. It is an operational control problem. Restaurants need a system that translates legal distinctions into daily payroll, POS, and accounting behavior before the audit letter arrives. So what is the solution? The approach is to build tipping policy from the strictest applicable rule down, using a systematic 5-pillar framework that treats compliance like the critical business system it actually is. First, identify every federal, state, and local rule that applies to each location. Then choose the rule that gives employees the greatest protection. Second, write a clear policy that defines every category. A voluntary customer tip belongs to the employee. A mandatory service charge belongs to the restaurant first and only becomes wages if paid out. Third, connect that policy directly to your operational systems: POS buttons, payroll codes, accounting accounts, manager approval workflows, customer disclosures, and daily records. Fourth, train managers thoroughly before they can approve any tip pool change or service charge adjustment, not as an afterthought when mistakes have already been made. Fifth, establish daily operational controls that create an unbreakable audit trail. This isn't just paperwork. It is a complete operational methodology that becomes embedded in your restaurant's DNA. Compliance is not the side dish you can ignore. It is the main course that keeps your entire operation healthy. The core findings are the precise distinctions that change the outcome entirely. First, voluntary tips are employee property. Employers generally cannot keep them. Employees must report cash tips of $20 or more per month, and employers must include all reported tips in withholding and FICA processes. Second, automatic gratuities and mandatory service charges are not tips for tax purposes. They are restaurant receipts first. If paid to workers, they become wages, reported on W-2 forms, not as tips. Third, if a restaurant claims a federal tip credit, the federal cash wage can be as low as $2.13 per hour, but cash wages plus tips must together reach the applicable minimum wage, and the employer must make up any shortfall every single shift. Fourth, tip pool eligibility depends on whether a tip credit is taken. With a tip credit, the pool is restricted to employees who customarily and regularly receive tips. Without a tip credit, a broader pool can include back-of-house roles, but managers and supervisors still cannot keep pooled tips under any model. That is the breakthrough insight. The same restaurant can be fully compliant or catastrophically non-compliant, based entirely on how each dollar is classified, routed, and documented. The money is the same. The label is everything. Now let's make it real. The implications show up in the back office every single day. Credit card tips collected by the restaurant should be recorded as a liability owed to employees until actually paid, because those tips legally belong to employees. Service charges, by contrast, should be recorded as restaurant receipts first, then reclassified as wages only when paid out. Here is the concrete example. A server earns $500 in card tips, and the processor charges a 3% fee, $15. The accounting entry records $485 to the bank, $15 as processing fee expense, and $500 as tips payable. Payroll still needs the full $500 in tip wages for withholding and FICA, not just the net deposit amount. If 20% or $100 is tipped out to bussers and the bar, the books should move that amount through a visible tip-out payable trail with documentation at every step. This is precisely where compliance becomes visible and provable. Your POS, payroll system, bank deposits, processor reports, and daily tip logs must all tie together perfectly. If those numbers don't reconcile, that is exactly what an auditor looks for first. The resolution is a fundamental paradigm shift in how restaurants operate from the ground up. Tipping can no longer be treated as an informal end-of-shift habit. It has to become a repeatable, disciplined compliance loop. We have moved from the old era of guesswork and hoping you don't get audited to the modern era of systematic, provable compliance. The December 2024 DOL restoration rule was not a minor legal tweak. It was a clear signal that federal enforcement is serious and getting stricter. So here is the loop. First, confirm the rules for every location. Second, refresh the written policy. Third, lock in POS and payroll settings that separate every category. Fourth, train managers before they touch any pool, service charge, or tip sharing decision. Fifth, keep daily records without exception. Sixth, reconcile POS, payroll, bank, and processor reports monthly. Seventh, self-audit when risk is high, especially after wage changes, new locations, changed job duties, or new service charge practices. Restaurants that build this foundation today will effortlessly adapt to whatever changes tomorrow brings. When the federal minimum wage increases, when states add new pooling restrictions, when technology enables real-time monitoring, you will be ready, not scrambling. Let's close the story with the 5 separations that matter most for 2026. Separate voluntary tips from mandatory service charges. The label determines the tax and wage treatment. Separate tip credit restaurants from full cash wage restaurants. The model determines who can participate in a pool. Separate lawful documented tip pools from casual undocumented tip outs. Paperwork is protection. Separate managers and supervisors from pooled tips. This rule has no exceptions. And separate every record stream. POS closeouts, payroll registers, bank statements, processor reports, service charge disclosures, employee tip logs, and tax work papers must all tie together. If restaurant owners do those 5 things consistently, they dramatically reduce wage claims, payroll tax errors, Form 8027 problems, and staff confusion. The safest path is practical and repeatable. Document the policy, configure systems correctly, train managers before mistakes happen. Keep daily records, reconcile everything regularly, and review the rules whenever wages, locations, roles, or tip-sharing practices change. The restaurants that thrive in 2026 won't just have great food, they'll have great operational systems. Your employees will thank you, your accountant will thank you, and your future self will definitely thank you. Now go build your compliance foundation, one shift at a time. Like and subscribe for more helpful videos like this. Connect with Forks for the experienced accounting professionals your restaurant needs. Details in description below.